Right, good time to get in Geoff Dennis, the independent emerging markets commentator who joins us now on the show. Thanks a lot, Geoffrey, for joining in. The way the queues are stacked up globally right now, as Prashant was earlier talking about the Supreme Court, beginning to hear what happens about the tariffs, etc. Irrespective of that, what's your view currently as the world is positioned on emerging markets, the China versus India allocation? How would you distribute?
Well, first of all, emerging markets are clearly having an incredibly good year. They're up over 30% now and outperforming developed by 1,200 basis points. And why that's particularly good, I think, is that although the EM was driven considerably earlier in the year by a lot of rotation as the dollar was weakening, classic environment for EM to do well. The dollar has actually rebounded a little bit recently, especially against the euro and one or two other currencies as well, including in EM. And yet EM is still powering forward. Now, EM has been driven by a number of large markets, but China's doing well, Taiwan is doing relatively well, Korea is doing exceptionally well, Latin America, Brazil and Mexico are doing well. So I think there are some individual stories as well. But I'm a little nervous about how much more EM is going to do if the dollar is going to continue to rally. And that, of course, will bring us back at some point, I'm sure, in the conversation to the Federal Reserve. I'm sorry to say, I remain very skeptical about the China story. Yes, they've got a lot of AI-driven investment there and also therefore benefiting the markets. But for me, the outperformance between China and India this year has been so dramatic that I would be looking to rotate back into India, where the inflation's very low, of course, partly because of food inflation. I think you're going to see lower interest rates down the road. The economy's looking good. The GST reform is good. So I would be very skeptical chasing China at this point, and I think some rotation to India would make sense.
Got that. Geoffrey, morning. Good to have you with us here. And the IT stocks all, of course, the big AI deals continue one after the other. Almost, it's incredible, right? And tens of billions of dollars almost every day or every second day. What do you make of it at a broad level? I think as someone was saying, I think Michael Burry tweeted, right? Sometimes you can do something about it. Sometimes you just got to sit back and do nothing. There's not very much you can do except watch. And if you, of course, own some of these names, great. What's your sense?
I think that this is a very good environment. Excuse me. This is a very good environment generally for corporate action. If you can find cheap enough companies which are being perhaps badly managed, or just good names that really should be doing quite a bit better. And I think that's because interest rates have started to come down. Cost of capital is lower than it was a few months ago. The economy is still doing remarkably well in the US, especially on investment, to a certain extent on consumer spending. And of course, you're getting a lot of deregulation from President Trump as well. So I think as you suggested, I think you said Michael Burry, who of course made so much money shorting the housing market in 2007, 2008. I think you follow what he's suggesting, and that is you just wait and just enjoy the action. I think there's probably quite a bit more to come because corporates have got a lot of cash. As I say, the cost of capital is coming down, and bond markets are behaving well. So yeah, I think you're going to see more corporate action as we go forward.
You said that you're not very gung-ho on China, and you said emerging markets have done well. One of the emerging markets which hasn't done well through this year, and if you compare it to all the others in the world, has been India. And that's perhaps on account of valuation discomfort. Where do you stand on India now?
Well, as I said, I think that some rotation from China into India may make a fair amount of sense now, because although China has had the benefit of the focus being on China with respect to Trump trying to get some deals on tariffs, of course, and trying to avoid, hopefully, at the end of the day, a major trade war with China. They've got the rare earths, which is very beneficial. But meanwhile, the economy is still very soft, in particular, consumer spending and housing, and the manufacturing sector is contracting still. And so I think China, although it began the year very cheap, is beginning to run ahead of itself. Whereas India obviously was the other way around. It had done very well. The market was expensive. But I think India's got some definite things going for it at this point. The oil price is in a good range. It's not strong. It's not weak. It's coming down a little bit more in the last couple of days or so. I think there's tremendous scope still for the RBI to cut interest rates. The valuation gap versus China has, of course, now narrowed by definition. And I think the economy is still doing relatively well. And you've got a few reforms coming through, GST obviously being the obvious one. So I'm a bit of a broken record on this. I've expected India to improve a bit more, but I really think it's a good story here, particularly versus China, given how much China has outperformed.
All right, Geoffrey, thank you so much for joining in and giving us your perspective on emerging markets and saying that maybe perhaps it's time now to shift some capital away from China into India. With that,